On October 24th, 1929, the New York Stock Exchange floor fell silent. The ticker tape jammed. Brokers stared at the boards as panic spread. In a single day, $14 billion in paper wealth vanished. The world's financial system was brought to its knees by a sudden, total loss of trust. 79 years later, in September 2008, Lehman Brothers collapsed. Global credit markets seized up. Banks stopped lending to each other. The world's financial plumbing froze. The panic was different in detail, but identical in feeling. A system built on confidence suddenly stripped bare. Now, in 2026, the same warning signs are flashing. Record debt, shadow banking, and a new breed of financial products. Each crisis began with a shocking event that revealed the system's hidden fragility. Every crash starts with a day no one forgets. Why do the same signals keep repeating right before disaster? The answer is in the way markets are built, on cycles of boom and bust, on the illusion that this time is different, on the hope that someone else will blink first. The panic of 1929 feels disturbingly similar to the uncertainty investors feel today. The headlines change, but the pattern remains. In every era, the world's leaders promise stability. Each time the rules change and the dominoes fall faster. But to see the pattern, we need to go back to the first domino, when the world learned how fragile markets really are. In 1927, the streets of New York pulsed with jazz, neon, and the hum of prosperity. The roaring 20s were in full swing. Factories churned out cars and radios. Stock tickers clattered in every brokerage. Ordinary Americans, for the first time, poured their savings into the market. Taxi drivers, teachers, and housewives all wanted a piece of the boom. But the boom was built on sand. Brokers offered easy credit. Buy stocks with just 10% down, borrow the rest. Margin debt soared. The market climbed higher, feeding on itself. Newspapers ran stories of instant millionaires. The emotional echo was intoxicating. The optimism of the 1920s feels eerily similar to the euphoria before every crash. By late 1929, the cracks were showing. Steel production slowed, farm prices fell, but the market kept rising until it didn't. On October 24th, 1929, Black Thursday, panic selling began. By Black Tuesday, October 29th, the dam broke. Margin calls went out. Investors who couldn't pay were wiped out. Banks, exposed to the market, began to fail. The collapse spread like wildfire. Bank runs swept the country. People lined up for hours, desperate to withdraw their savings. But the vaults were empty. The term bank run became a household fear. As banks failed, credit vanished. Businesses closed. Unemployment soared. The world slipped into the Great Depression. Deflation set in. Prices fell, but debts remained. Farmers lost their land. Families lost their homes. Bread lines stretched for blocks. Soup kitchens became the new normal. The emotional toll was devastating. The promise of the American dream was replaced by the reality of hunger and despair. How did a decade of euphoria end in breadlines? What happens when everyone tries to sell at once? The answer is in the way leverage, trust, and fear can turn a boom into a bust overnight. The lessons of 1929 were supposed to last forever. But history had other plans. In 1933, the U.S. Congress passed the Glass-Steagall Act. Commercial banks and investment banks were split. The Securities and Exchange Commission was born. Deposit insurance was introduced. The scars of the Great Depression were still raw, and the new rules were meant to keep the panic from ever returning. For a generation, it worked. The emotional echo was relief, stability returned, and trust in the system was slowly rebuilt. Wall Street was tamed, at least on the surface. The American middle class grew, home ownership soared, the stock market recovered, but the wild swings of the 1920s seemed a thing of the past. But markets are living things. They adapt. By the 1960s, a new bubble was forming, the conglomerate craze. Companies merged and acquired, building empires on borrowed money and creative accounting. The cycle repeated: boom, bust, bailout. In the 1980s, financial innovation took center stage. Junk bonds, leveraged buyouts, and new derivatives promised higher returns. Michael Milken, the junk bond king, became a symbol of the era. The savings and loan crisis wiped out hundreds of banks. The term regulatory arbitrage entered the financial lexicon. Banks and traders found ways around every new rule. The 1990s brought the dot-com mania. Silicon Valley startups with no profits went public at sky-high valuations. The Nasdaq soared. The emotional echo was euphoria until the bubble burst in 2000, wiping out trillions in paper wealth. Each time, new rules created new loopholes. Every fix planted the seeds of the next crisis. The term moral hazard became a warning. When markets believe the government will always step in, risk-taking grows unchecked. By the 2000s, the world was more connected and more vulnerable than ever before. Globalization, deregulation, and technology had created a financial system that was bigger, faster, and more complex than anything the world had seen. The emotional tension was building. Lessons of 1929 were fading. The next bubble was already inflating, hidden in plain sight. By the 2000s, the world was more connected and more vulnerable than ever before. In 2007, the world's financial system was humming with confidence. Real estate prices had soared for a decade. Banks handed out mortgages to anyone with a pulse. Wall Street sliced and diced those loans into complex securities, collateralized debt obligations, CDOs, and sold them around the globe. The profits were enormous. The risks were buried. But beneath the surface, the system was rotting. Subprime borrowers, millions of them, were falling behind on payments. The value of mortgage-backed securities began to slip. Hedge funds and investment banks loaded with leverage started to wobble. Then, in September 2008, the unthinkable happened. Lehman Brothers, a 158-year-old Wall Street titan, filed for bankruptcy. The world's credit markets froze. Banks stopped lending to each other. The shadow banking system, hedge funds, money market funds, off-balance sheet vehicles, seized up. The panic spread from New York to London, Frankfurt, Tokyo, and beyond. The emotional echo was instant. The panic of 1929 felt disturbingly similar to the uncertainty of 2008. Investors watched in disbelief as the Dow plunged 777 points in a single day. Lines formed outside failed banks. Governments scrambled to guarantee deposits and inject capital. The Federal Reserve slashed interest rates to zero and launched emergency lending programs. The term systemic risk became a household phrase. The world realized that the financial system was a chain of dominoes. One failure could topple the rest. Central banks and governments coordinated massive bailouts. The U.S. passed the $700 billion TARP program. Europe and Asia followed suit. But the rescue came at a price. The public was furious. Main Street watched as Wall Street was saved while millions lost homes and jobs. The emotional toll was deep. Trust in the system was shattered. How did a housing boom become a global bust? What happens when the world's safety nets are tested and nearly fail? The answer is in the way leverage, complexity, and blind faith in models can turn a local problem into a global catastrophe. The 2008 rescue was supposed to end the cycle, but the pattern was only getting stronger. In the aftermath of 2008, the world's central banks reached for tools no one had dared use at this scale. The Federal Reserve, the European Central Bank, and the Bank of Japan unleashed quantitative easing, buying trillions in bonds and mortgage securities. Interest rates fell to zero, ZERP, and stayed there for years. The emotional echo was relief, then euphoria. Markets soared. The S&P 500 doubled, then tripled. Real estate rebounded. Tech stocks exploded. A new generation of investors, raised on apps and memes, poured into the market. Bitcoin, once a curiosity, became a global phenomenon. The everything bubble was born. But the boom was built on debt. Governments borrowed to fund stimulus. Corporations issued record bonds to buy back shares. Households took on new mortgages at rock-bottom rates. The world's total debt hit new highs. First $200 trillion, then $250 trillion, then $300 trillion. Financialization reached every corner of the economy. Private equity bought up homes, farmland, and even water rights. SPACs, meme stocks, and NFTs became the new lottery tickets. The emotional tension was back. The optimism of the 2010s felt eerily similar to the euphoria of the 1920s. Yet beneath the surface, fragility grew. Shadow banks, hedge funds, private credit, fintech lenders took on risks that traditional banks avoided. Leverage crept higher. The system became more complex, more opaque, and more dependent on the promise that central banks would always step in. How did the cure for the last crisis become the fuel for the next? Why does every boom feel safer until it doesn't? The answer is in the way easy money, new technology, and the hunger for yield can turn stability into a trap. Now, the same warning signs are flashing again, and the stakes are even higher. By 2026, the world's financial system is bigger, faster, and more complex than ever. Global debt has soared past $300 trillion. Shadow banks, private equity, hedge funds, fintech lenders now rival traditional banks in size and reach. The lines between regulated and unregulated finance have blurred. On Wall Street, AI-driven trading algorithms execute millions of trades a second. In Singapore, private credit funds lend billions to companies that can't get bank loans. In Dubai, digital assets are traded 24/7, with prices set by code, not by humans. The system is a web of contracts, derivatives, and promises, each one dependent on the next. But the risks are hidden. Leverage is everywhere. Basis risk, the danger that prices in related markets will suddenly diverge, haunts every trader. Liquidity, once taken for granted, can vanish in an instant. A single shock, a failed hedge fund, a cyber attack, a sudden rate hike can trigger a liquidity crunch that ripples across the globe. The emotional echo is unmistakable. The panic of 1929, the chaos of 2008, the uncertainty of every modern crisis. Each time, the world's leaders promised containment. Each time the web tightened and the dominoes fell faster. Are we building a smarter system or a more fragile one? What happens when the next domino falls? The answer is, in the way complexity, speed, and leverage can turn a small problem into a global catastrophe. To see the future, we need to compare the cycles, how every crash rhymes even as the details change. In 1929, the world learned how quickly trust can vanish. Margin debt, speculation, and a sudden loss of confidence turned a boom into a bust. The crash spread from Wall Street to every corner of the globe. Banks failed, credit froze. The Great Depression began. In 2008, the world learned the same lesson, this time with new tools. Subprime mortgages, CDOs, and shadow banking created a web of risk that no one fully understood. When Lehman Brothers fell, the panic spread instantly. Contagion became the word of the year. Governments and central banks scrambled to stop the dominoes, but the damage was done. The system survived, but only after a massive, coordinated rescue. Now, in 2026, the pattern is repeating. Debt is higher, leverage is deeper. The tools are more complex, AI trading, private credit, digital assets, but the core risks are the same. Trust is fragile. Liquidity can vanish. A single shock can trigger a global reset. The emotional echo is clear. The panic of 1929 feels disturbingly similar to the uncertainty of 2008, and both feel eerily close to the anxiety of today. Each time, the world's leaders promised, never again. Each time, the cycle returned. Are we doomed to repeat the same mistakes? What did past panics teach that today's markets keep forgetting? The answer is in the way leverage, trust, and contagion always find new forms, but never disappear. So what can you do before the next pattern completes? Every generation believes it has tamed risk, built a smarter system, and left the last crisis behind. But the cycle always returns. Leverage builds, trust grows complacent. A new product, a new market, a new promise, until the next shock exposes the cracks. The panic of 1929, the meltdown of 2008, the anxiety of 2026, each is a warning. The details change, but the emotional core is the same: fear, denial, and the scramble for safety. The world's leaders promise never again. Regulators write new rules, markets adapt. But the next bubble always finds a way. The real danger isn't the crash itself, it's the forgetting. Belief that this time is different. The temptation to ignore the signals, to trust the models, to believe that someone else will take the hit. Will you be ready when the next domino falls? Will you recognize the signals before the headlines hit? The answers are hidden in the past, if you know where to look. Don't assume the rules of money and risk are set in stone. Watch for the signals: rising leverage, new forms of credit, the quiet buildup of systemic risk. Pay attention to the canaries: liquidity crunches, sudden spikes in volatility, the return of old fears in new forms. In every reset, someone is early, someone is late, and someone never even realizes a reset happened. The question is not whether the pattern will repeat, but whether you'll see it coming. Subscribe for more cinematic economic history and learn how to spot the next crisis before it hits.